Buenos dias, good morning. This is Manuel Vargas with Keller Williams Realty Landmark. We are here with Mr. Victor Andrade from Meadowbrook Mortgage Bankers. He's a loan officer with many years of experience specializing in residential financing. And we are going to talk today about basic credit considerations for from the perspective of the lenders. So what should buyers be concerned with when they are going to buy a property or thinking of getting pre-approved or thinking of getting a property? What are the credit considerations? Good morning, Victor. Please tell us a little bit about you.
Good morning, Manuel. Obviously, my name is Victor Andrade. I work at Meadowbrook Mortgage Bankers. I have my offices in Astoria, Queens. I've been in the industry for 17 years now. Can't even believe it's been that long, but 17 years. And I'd love to get this started to try to see if we can help people out, improve their credit so that, because credit may not be the most important part of a mortgage transaction, but it is an important part of it.
It's one of them. I usually say the way I learned the business is that a real estate transaction from the financing point of view is based on 4 legs of the table: credit, income, assets or down payment, and then the 4th leg is the property, the collateral. If you remove one of these legs, the table is wobbly. So we're going to talk about the credit. First of all, I want to ask you, because we deal with a lot of people that are first-time home buyers. They are getting started in life, or they may be immigrants, first-time immigrants, and they manage finances in a different way in their own countries. So the first question is, how do you establish credit when you have no credit history?
Well, there's a few ways to establish it. The way that, let's say, my mother established it for myself, right, when I was a young kid, teenager, college, was she added me on as an authorized user on a few of her credit cards, right? Gotcha. You have to make sure that those credit cards are being paid on time and never had a lateness. So what she did was she added me onto a couple of her credit cards. And, after a few years of being on there, I had credit, or even a few months.
Well, here's the question. Did you have good credit, or did you screw up her credit?
No, luckily I kept it good, or else my mother would have put a hurting on me.
So let me translate this to put in very plain terms. So what Victor is saying, you have no credit history. The easiest way is to get a relative, somebody that's very close to you, which will add you as an authorized user for one of the credit cards that they have, and that they are paying on time. Don't look for the deadbeat uncle to give you another credit card, because you're gonna have the bad credit of the uncle. Look for the people that have good credit in your family to add you as an authorized user and use the credit properly.
Correct.
Very well, Victor. Another question. When I started, when people had no credit, there used to be this other avenue of getting non-conventional credit, like the car insurance or the cellular phone bill. Does that still apply?
Yes. Yeah. So nowadays, the credit bureaus, Equifax, TransUnion, and Experian, they have added where you can add your utility bills, right, as a self-reporting utility bill on your credit report. So you could do your cell phone, your light bill, your cable bill, insurance.
How do you do that? How do you add that to your credit bureaus?
Yep, you open up an account with one of the 3 credit bureaus. It could be Experian, TransUnion, Creditfax, or all 3 of them, right? And you log on and you add and report those utility bills onto their website. That way, it starts reporting on your credit report, and it'll read as a self-reporting utility bill.
Yeah, I realize that this may sound a little complicated for somebody, but that's why we have you. If somebody is looking to do this, they need tips on how to establish their credit, can they call you, set up an appointment, even if they are not buying right now?
Absolutely. It's a very simple step. I'll show them how to do it. It's very quick and easy, and it'll take minutes. Okay.
The second question that I have is, what is the lender looking for when they check somebody's credit? And I'm referring to, they're checking the ability of the borrower to manage credit. They're checking for debt to income ratio. Can you explain these concepts a little bit?
What they're looking for is basically, are you able to receive a bill and make a payment? They want to know whether or not you're responsible enough to be able to get a payment, receive a bill, manage it, go to your bank account, and send the payment out. Are you able to manage a checkbook? Are you able to manage a credit line? Meaning, just because we give you the ability to max it out to, let's say, a $5,000 credit card, doesn't mean that you're gonna go and just spend those $5,000 and keep it maxed out forever, because that's gonna affect your credit. The reason why they check your credit is to see what kind of person you are in managing your finances. They obviously can't check your checking account. We can't check your savings account. You can't check any other aspects of it. So the way that the banks determine this is by checking your credit history, which tells us how you manage your credit based on prior liabilities that you had.
Okay, so to summarize this, what you are saying is basically the lender is checking how organized are you with your finances. If you not only are able to receive credit, but to manage to make the payments, to use it judiciously, and not to max out all the credit accounts, because then they realize that you are getting too much debt. So that gives me a segue onto the next part of this question is, what is a debt to income ratio? I don't want you to be very complete about the answer, just to give the concept to the people.
The debt to income ratio is a percentage of your monthly liabilities and the proposed mortgage payment to the amount of income that you bring in on a monthly basis, but your gross income, right? So if you're somebody that, let's keep numbers simple. If you make 120,000 a year, right? That's 12 months in a year, that's $10,000 a month. Right? So if you're going to buy a house and your mortgage payment is going to be $3,000, and then you have a car payment, a couple of credit cards, and that's another $1,000, that's $4,000 a month. That means that your debt to income ratio is 40%, because 4,000 is 40% of 10,000.
Got you. So basically, by looking at the credit, the lender also has a window to see how much debt you have, how much recurring debt, how much how many credit cards, if you have a car lease, if you have any other mortgage, right, which could be an issue. So they can see how much debt you have as compared to your income, and that plays a role in whether you can buy or how much you can afford, right?
Correct. That is correct. Yes.
Very good. The third question that we have for today is that, as a matter of just knowledge for us, I know there are different lending programs. There are some federally backed loans, there is conventional loans, there is jumbo loans, there is a lot of different ones. But I want you to tell us what credit scores, average credit scores, are required for the most common programs.
Well, the most common programs are obviously conventional and FHA, right? Conventional, it consists of a Freddie Mac loan and a Fannie Mae loan, right? If you're self-employed and you're trying to do a 1-year tax returns program, you're more likely going to need a 700 plus credit score. If you're going to use 2 years of tax returns, then you can use it, depending on how much you put down as a down payment, you can go as low as 640 credit score, right?
Excuse me, 700 for which program was that?
The 1-year tax returns program, which is for people who are self-employed. Right, we could do a 1-year tax returns program, the most recent tax return, and we'll do with 700 over 700 FICO typically. If you are going with 2 years of tax returns, meaning you're a wage earner or you're self-employed but have 2 years of tax returns that you can use to qualify, then you can go typically as low as 640, depending on your down payment. And the other one is the FHA loan. That one varies, right? Most banks will go as low as 640. We will go as low as 620. Right, depending on the DTI, and there's even times where we can go all the way down to 580.
Wait, DTI, debt to income ratio.
Debt to income ratio, yes.
Don't get too technical on my guys, please.
Yeah. Sorry. So if you're on the FHA, technically we can go down to 580 FICO score, credit score. Oh, wow. If your DTI or debt to income ratio is below 43% total, which are mortgage payment expenses and your PMI, your monthly payments, right? So that is, again, it's very contingent on how strong your assets are and how strong your income is.
Okay, so let me summarize. Basically, if somebody is looking to show only 1 year of tax returns because they are self-employed, they would need at least a credit of 700. If somebody is willing to show 2 full years of tax returns, or they are able to show 2 full years of tax returns, the credit could be as low as 640.
On a conventional.
And then the FHA program, which is a program that is federally backed with very a lot of facilities, a lot of benefits for first-time home buyers. You know, you could go below 640 and you could go as low, excuse me, as 580, provided there are some compensating factors like a better debt to income ratio, right?
Correct.
Okay, very good. So that's a good reference for everybody. I used to have this consensus that the people needed 650 or 680, but this is always changing, this criteria, right?
No, not necessarily, Manuel. This has been pretty common in the last 10 years or so.
Oh, wow.
The thing is that what happens is that it's, you know, with people who have a 580, for them to admit those compensating factors, it's very difficult. So,
right.
you know, not everybody can meet those compensating factors and that criteria, which is why most lenders won't go below 640 because almost nobody meets those criteria. But there are a few that have, right? So I don't want to, you know, turn away people that potentially could meet that criteria if they do. If they had what happens is some people, you know, maybe they're going through a divorce, right? Like I had this case where a lady had a 580 credit score. She was going through a divorce. Her and her husband weren't getting along very well. They stopped making the payments. They had some issues. The divorce was finalized and she was making her payments. It was taking her time to get her credit up, but she had enough income. She had enough assets, but her credit score wasn't there. But she had good credit history prior to the divorce. So we made an exception for that.
Okay, so that's on a case-by-case basis.
Correct.
I'm sorry, I'm too close to the microphone. So this brings me into the next question. You know, in my, you know, of course, you know your business. I do something similar to you, but, you know, I'm showing houses out there. And in my real estate agent's mind, I always thought that good credit or very good credit was 700 or 750. And then when I found people that were above 800 or 850, I would tell them, you must be very cheap, right? Joking, because I thought that only very cheap people can have credit scores above 800. But here is the question that leads us into this is something I heard, but I have seen very rarely. What kind of credit score or what kind of score allows you to get a better rate on a mortgage? Is it true that if your credit is beyond, I don't know, 750, you could get a 1/8 of a percentage less? I heard these things and I haven't seen it happen very often.
Well, you know, the interest rate, you know, it's not just based on the credit score. It is true that the higher the credit score, the better the rate could be potentially. Right? Now, correct. Now, but there's a lot of different factors. If you have a 700, even 700, and you're buying a house and you're putting down 40% and you're buying a one-family house, you can get just as good or even a better rate than somebody that has a 780 credit score, but only putting down 5% on a one-family or a two-family house and maybe going FHA or conventional. Right. So it really depends. It's not, the credit score is important, like we stated at the beginning of the conversation, but it's not the final fact that determines what the rate is. And typically on conventional loans, right, the credit score is based on buckets, right? So different levels. So anything above 740, it doesn't matter if it's 850, it's the same as 740.
Right.
So the next bracket is 720 to 739. Then it's 700 to 719. Then it's 680 to 699. Then it's 660 to 679, and then so on and so forth. Every 20 points, the lower it goes, you're falling into another lower level, right? And then the lower the credit score, the more compensating factors are needed for you to get the loan.
Got you. So basically, it is not the only factor, right? It helps. It could help reduce the rate, provided the other factors are good, but when the other factors, the other compensating factors are very good, it may not make as much of a difference, but it could make a difference. Okay, that's fair enough. Our next question is, if you have people that have credit issues at any level, you know, credit could be bad, fair, good, very good. How do you improve your credit from bad to fair, from fair to good, and how long can it take?
That's a very open-ended question.
So try your best, try to summarize.
It really depends on what you have. So if you have collections, right? Collections are the type of thing that they hold you down. It's like you're drowning and they don't let you come up for air. So you want to try to resolve the collections as quickly as possible. Now, when you pay off a collection, at the beginning process of you paying it off, it actually brings down your score most of the time. But don't be alarmed. It'll start going up right after it goes down for a little bit, because what happens is a collection goes in your credit report, but it hasn't been established that it is your collection and that you do owe that money. So it brings it down for the purposes of, hey, you have to settle this out. You have to, get to it, right? But again, if you pay it off, then you're acknowledging that it was yours, so it brings it down momentarily. But then your credit starts going up because now you're not being held, you're not drowning anymore. Now, if you have latenesses on your credit score, like credit cards, mortgage payments in the past, or things of that nature, it's a little bit more difficult, because if it is a true lateness, then the only thing that can really help is time. Time heals it, right? So the longer that passes by, and the better you manage your credit, your monthly debt, that'll help you get your score up a lot higher, right? The main thing is that I see that a lot of people, it gets affected is they just say, oh, but I've been making my monthly payments. Well, it's not just about making your monthly payments. It's how much do you owe according to your monthly or your credit limit. So if your credit limit is $5,000 on a credit card and you owe $4,500, that's no good. That's going to affect your credit score. Because what happens is this: if you have, let's say, 3 or 4 credit cards, and your total limit on those credit cards is, let's say, $10,000, and you owe $9,900, that means you're choking. Okay, you're choking yourself. That means you're overextended, right? So that naturally the credit bureaus are going to lower your credit so that you don't continue to overextend yourself, right? So if you want to be around the 25% mark of whatever the credit card limit is, and that'll definitely help. You can keep it low. You can use it. Pay your gas bill. Go get gas. Go to the supermarket. But try to pay off most of it, if not all of it, by the end of the month, right? And another way to help you get your credit score is, like it is to start your credit score. Ask a family member or a friend if they can add you on to a couple of authorized user credit cards that have never been late, to help you, assist you in getting your score up a little bit higher. That typically is the one that is the quickest, but that doesn't mean that you don't have to address all the derogatory credit you have on your credit report. That still needs to be addressed, right? But again, you can be added on a couple of credit cards and liabilities to help you increase your credit report.
So I realize it is a very general question, and we could have seminars upon seminars on how to improve your credit. And I realize that, but thank you for summarizing those points. I'm going to repeat them. If I say something wrong, you please correct me. So basically, collections drag you down. You want to take care of the collections immediately. It may take a little while for the credit to improve, right? But collections are a big red flag. Then we have lateness, and the cure to being late in your credit card payments or in your credit payments is time. You can start paying on time, but the credit doesn't improve right away. So you have to address the lateness. Then the other thing that you talk about is about your credit limits. If you are using the max of your credit limits, then that's considered bad from the credit perspective. Your credit score is being lower because you're using too much of your credit. And the general rule of thumb that you said is that you should keep these balances up to 75% of the allowed maximum credit that you have, right?
25%.
Yeah, so you could keep the balances up to 75%.
Yeah, keep it clear, 75%. But the balance,
so just use 25% of the allowed maximum. You see, I had it wrong. So 25% of the balances, keep it under there, right? And then you said that if you have a credit score that is ailing, that is not that strong, the easiest way is what we said at the beginning: get your accountant, brother-in-law that pays everything on time, and say, hey, buddy, let me treat you to a beer. Can you add me to your American Express, and you build up your credit quickly like that.
That's correct.
I want to ask you a question that, there are some misconceptions. There is many misconceptions, but one of the common ones is that some people think that because they have bad credit, the best thing they can do is go ahead, pay off all the credit cards and close them. And that's a no-no, right?
That's a big no-no.
Okay, please explain.
How is your credit going to go up? How are you going to show the credit bureaus and the banks that you can manage good credit if you have no credit? if
But
you have
people
no
think
credit cards.
I paid everything off. People think they're doing a good thing, but it's not really good.
Closing credit cards, closing accounts is the worst thing you can do. It'll affect your credit and bring it down even more. And if you close them all, then you're back to zero, you know? So it doesn't help. You want to pay them down to either a very small balance or zero. It's fine as well, but don't close them. Don't ever close accounts. What I do is I have tons of credit cards, right? I only use really one. I only use my American Express. I use it, I pay it off at the end of the month. That's it. I don't use any credit. I have them because I've had them for many years, right? But what I do with most of them, I either keep them in my closet, don't use them. And if, let's say you get like a special on one credit card, you go to PC Richards and they give you 10% off and all that, and you open up a credit card, right? You get it? What do I do when I get it home? Cut it up, throw it away.
Okay, so you just bring another question. So basically you are saying, if you have a credit score that needs work, don't go and pay off and close the accounts. Closing the accounts basically is telling the banks you cannot manage your credit. Now, having said that, having too many credit lines could be a problem too.
Correct. Having too many that you're using and having a balance and are overextended can be a problem.
When you use them, okay.
Correct. Correct. Like I said before, I probably have 10 credit cards, but I only have one that has a balance. And the only reason I have that many is because I have a couple of department stores. Macy's, PC Richards, Victoria's Secret, whatever you can get, right? So sometimes you get them and they're there. Sometimes they even close them on their own because I don't use them, right? And that's okay. Right. That's not a problem. But I have a lot, but I don't use them, and I just use my American Express. I have mortgages and I have car payments, so that's more than enough monthly credit that I have established already. So I don't feel the need to have to use them. But if you're the type of person that only has a couple of credit cards or 5 or 6, you should not use all of them. And if you do use all of them, again, just stay around the 25% mark.
Okay, that is very explanatory. Thank you so much. Now, if people have some of these credit issues that we are talking about in general, and I know I'm putting you on the spot, but just being positive, if somebody has that, is thinking of buying a house, could some of these issues be worked out while they are going, while they're in the process, where they are in contract, pending closing, that takes 60 to 90 days? Could some of these issues be resolved?
Yes, depending on what the issue is. Depending on what the issue is. There are some that I've been okay with going into contract when the person didn't have the credit score that was required, but I knew that within that 2 to 3 months time frame that we will be able to raise it up and get it either raise it up or get it resolved. So yes, there are instances where that's the case, and we can do that, but that's not all. As a matter of fact, that's not most instances. That's only a rare occasion where I know for a fact that it can be resolved within the time frame that's necessary, because we also don't want to go into contract and jeopardize the buyer's down payment, and obviously not be truthful to the seller about what's happening, because I'd rather be straightforward about what the situation is than have everybody waste their time.
Got you. So basically, this is a case-by-case scenario. You have to look at how bad the credit is, what are the issues at stake, so you can determine if they can be resolved in a reasonable amount of time to guarantee that you can close on the deal. But some of those issues could be addressed. I guess they would need to set up a consultation with the mortgage officer like yourself and find out, okay, these issues are not that bad. We can work them out in 2 months so you can close. You could go ahead and sign your contract, but it's a case-by-case scenario, right?
Yes.
Correct. Okay, now, can you tell us, we are in contract already. We have this couple that you pre-approved to buy this property. They have good credit. Everything looks good. What would you tell them not to do and to do with their credit while they are in contract before the closing?
Don't do anything.
Well, they have to keep paying their bills.
Well, yeah, keep paying your bills, yeah, but don't go apply to Ashley Furniture. Don't go get a new car. Don't do anything. Just keep paying your bills. Pretend you're not even buying a house. Just keep paying your bills.
Don't get new credit lines. Don't get new credit lines.
Don't do anything. Don't have anybody, run your credit to get any kind of new. Don't go apply for PC Richards to try to talk about the furniture. You can go look. You can go plan out what you're planning on doing but don't purchase or put anything on your credit report.
Don't get more debt, don't affect your credit. So like in the old country, we used to say, don't get the saddle before the horse. The horse being the house. Get the house first, then you get the furniture, then you get the new car and everything else, right? So basically you are saying when you are in contract, everything looks good. Don't start maxing out your credit cards, don't get new credit cards, don't buy furniture, etc. Which you laugh, but these things happens, right?
100%. 100%.
Right. Okay. Another question that we have is, and I see this when people, maybe they are new to the credit world and they mismanage the credit and they have credit that is low scores. And then you have all this advertising out there that people say, we'll fix your credit score, we'll consolidate your debt, the little bugs flying around, you don't have to pay back, etc., etc. What is your advice about these third-party companies that supposedly would save you from your creditors?
My advice is be careful. Be careful. There are a lot of people out there that pretend to be. There are scam artists, and they really don't know what they're doing. But there are a few out there that I know are decent. The problem with credit score is this. It's not a science. It's not a guarantee that things are going to work, because a lot of it is trial and error, right? So it's obviously my 17 years experience of looking at thousands of credit reports, I can pretty much tell you certain things that will work or certain things won't work, but you never know. It's not a science that it's gonna work 100% of the time. And so what happens is a lot of these credit companies, they lie or they overpromise. And then the client expects certain results, and then you don't get it, and then they're calling me asking me, why did this guy do this? And so that's why me personally, I don't refer anybody for those credit repairs, because it's so up in the air that it's very hard to gauge and guarantee that certain things are going to happen with credit.
So I'm going to put you on the spot again, because I know the answer to this question, and I know it's more work for you, but it's better for everybody. So given that it's very hard to judge these companies that improve credit, because some of them are good, some of them are not, there is some scams out there. I have seen where you help the people with the credit, you tell them what to do, you're not charging anything for it, you are doing it for free, just advising them that so they can eventually get a mortgage. Can you do that for people?
Yeah, no, I could do that. When clients come and they sit down with me and we do a consultation, I obviously not only consult them on what they need to qualify or how they qualify. I look at the credit report, and I give them what my advice based on my experience of what I've seen that has worked and what hasn't worked. Now, this advice that I'm going to give sometimes could be quick, but most times, depending on how bad the credit score is, it takes time, right? So I like to tell people that I'm helping them purchase a home, not necessarily at this moment, but it could be next year or it could be in 6 months. My goal is to help them prepare to purchase a home. So, my advice is what I give them is not where it's going to be done in 30 days. Like most of these credit bureaus, like, oh, we'll fix your credit in 30 or 60 days, Okay. That's just not possible in most cases. So I give them advice and I tell them, and then it's going to take a few months. Then it takes a few months or 6 months or a year. But the goal is to get you on the right path.
Okay, that sounds beautiful, which leads me into a practical question. How do they contact you? Can you give out your cell phone number?
Sure. My number is 347-495-2506. And my 2 offices are in Astoria, Queens. We can set up a consultation there. You can call me at that number, and then we can get together and we can just analyze your credit. Even if you're not ready right this moment, then we'll get you prepared for the future.
And I'm laughing because this is a silly question, but you'll be surprised how many people try to contact their finance person, their bank branch to do this thing. And the hardest thing these days is to contact somebody. I am a little old-fashioned, and I like when I call somebody and they pick up the phone, or I leave a message and they call me back, or they text me. I'm into text and emails. I can do that, yeah. and you get a response. So I know you can do that, and to me that's key in the business. Now let me ask you 2 final questions before Zoom kick us out of the meeting. The 2 questions are: what about cosigners? When you get a cosigner to sign on the loan because you need to show more income or more credit, or you consign for somebody. What are the implications, and what should you be concerned about cosigning for somebody or getting a cosigner?
Well, a cosigner is perfectly normal. Okay, somebody can, if you ask somebody to cosign for you, it's not going to affect them in any kind of way unless you don't make your mortgage payments. Okay, so if you have a relative that can cosign for you and assist you in purchasing the home, right? There's two things. That cosigner will put in second position. Okay, and once you make that mortgage payment for 12 months straight out of your bank account, and you can prove that, the cosigner can go and purchase his home on their own, and the mortgage that they're on with you will not affect them.
Correct. And so what you're saying, if I cosign for my brother, right, and he, he needed help for the income, that his income was not enough, and I cosign for him, and he made the payments on time, my credit is not affected, he spends 12 months doing that, then I can go ahead and purchase my home without having an adverse situation with my credit.
That is correct.
Okay. And the final question, which is also a very big misconception, people hear all these disasters and all these, terrible stories about credit, and then some people get very protective and sometimes very paranoid, which is understandable. Some people are like, I don't want to get pre-approved for a mortgage because they check my credit and my credit is going to go lower. So the question is, when you do a pre-approval and check somebody's credit, is the credit going to go lower? When does the credit go lower when you check it?
The credit scores go lower when you go and check for car loans, credit cards, personal loans, and things of that nature. For mortgage purposes, since the Dodd-Frank came out in the early 2010s, okay, the government has made it that easier for borrowers and consumers to go and check and get pre-approved and price check with other lenders without affecting their credit score, because they don't want what happened in the late 2000s to happen again. People be forced to purchase a home or take a rate or a program that they necessarily do not agree with. So they give you the ability to go and get pre-approved and have your credit checked with different lenders, right? So that you can go and pick the lender that best fits your needs and is going to give you the best program for yourself, right? So this misconception, right, that's out there is partly because sometimes other lenders and banks truthfully tell their buyers, don't go get checked because they'll lower your credit score, so that they basically lock in the client.
Basically,
right?
They don't want the competition. So
correct.
So your credit is not going to go lower when you are shopping for a mortgage and you get 2-3 pre-approvals. It's not going to affect your credit. But if you're getting new cars, new credit cards, that affects your credit, but not when you check for a mortgage.
Correct.
So, Victor, we are out of time. I thank you very much for your advice. And I know you have a lot of experience and you have very good customer service, which is what I look for when I'm dealing with a mortgage officer, because I don't want to have to talk to an assistant, to the secretary, to the assistant, to get to you. So I thank you for being approachable. And I know you speak Spanish, and that also helps us with our community. Thanks a lot, and have a great day. I'm going to stop the recording, and then we can chat for a little while.
Absolutely. Thank you, Manuel, for having me.